Well, it looks like this is us for a bit, so we'll just get started. As I think most of you know me, or at least have met me, I'm Tristan Roberts with Brick House Mortgage. We're the new in-house lender, and we're happy to be that. Really grateful for the opportunity, and of course, the relationship is the most important thing for us. Um, and so they asked me to teach the basic finance lending class today, which obviously I'm happy to do and is right up my alley. Going through it, they sent me an example slideshow of the Rev Up slideshow and a couple of different versions actually. And I kind of just revamped their thing. But the truth is, there's nothing I hate is a strong word, despise, too strong also. There's nothing I dislike more um, than a PowerPoint presentation. I think it can be just amazing information. And if you just get hit with death by PowerPoint, you absolutely burn out, miss things, don't enjoy it, and your brain kind of shuts down. So we'll blast through this, and I think you all have a copy. I have it in here. I'll make sure you all have this for reference points. But the truth is, I just want to make sure that at the end of this, everybody, and I'm pretty sure everybody here is experienced enough to know the basics. But we'll go through just some of the basics, but mostly I want this to be an open forum. Feel free to interrupt me at any time and we'll have conversations. That's kind of what I'm hoping for, is to have conversations. I've asked other people to stop in if they have good questions. If you have questions pertaining to loans or otherwise, let's just have a really great real estate conversation. You've got me for, I don't know, how long do these normally last? 45 minutes or an hour or something?
Hour.
Okay, yeah, you've got me for the next chunk of time, and I've got you guys here. So let's just chat. Let me know if you have questions. We'll just have conversations. Anything before we get started? Any questions or anything?
Nope, not for me.
Really awesome. Great. This is looking up. I'm just kidding. Okay, so welcome to RevUp. This is my first time using Zoom as the teacher. I typically I've been to tons of Zoom classes. I did some college Zoom classes even, but never actually had to teach on Zoom before. And this is my first time teaching the RevUp class, finance class. So you all may have more likely have more RevUp experience than I do. And so if there's something that you want to know or something I'm not doing that somebody else has done, a teacher in the past has done, please let me know. Honestly, you're not going to hurt my feelings. I just want to make sure that this is a enjoyable and helpful resource for everybody. So, all righty, let me see if I can get this going. Uh, so the purpose of this is just to make sure, from my understanding, that you all have a very basic understanding of lending practices and what's required for financing. Obviously, you're on the brokerage side, you're going to be dealing with the transactions, but it's helpful. Hey, Trinity. It's helpful to have a basic understanding of what we're working on and what we do, if anything else, so that you sound educated when you talk to your clients, which will just give you credibility. And I mean, you fake it till you make it kind of thing, which is really, really true. The experience will obviously give you the knowledge you need to take things a little bit farther, but being able to talk the talk is at first as equally as important than being able to walk the walk, if you will forgive the metaphor there. So learning objectives, basic types of loans. Well, this isn't helpful because I was going to ask what the basic types of loans are, but and then there's obviously state programs. We're going to go through disclosures, and we'll talk about mortgage payments and such. It's giving away all the answers. So I was going to ask, thanks, Trinity. It's going to ask what some of the basic loan types are. In fact, let's do that. Can you guys give me, let's say, 6 different types of loans? Okay, let's say 3, other than FHA, VA, and conventional.
Would
A
that be like
203K loan. Are you doing those yet, Tristan?
Say that again.
A 203K loan?
Yeah,
The
well,
renovation
that is, you're
FHA
right.
loans?
Yep, that is, so that's FHA, and that's a program. What about other types of loans? So that's a good one though.
Physician's loan.
Okay, yeah. So those are the same thing, but those are programs. But yeah, those are different specialty types of programs that can fit into both FHA and conventional loans. The truth is behind a lot of those loans, other than if a specific company like Kaiser or I know American Airlines has a really great loan product. They have these companies that have so much money, large insurance companies that they will actually fund their own loans for their employees. So a lot of times those loans are really credible. They're really worth it and they're awesome and really great. And so we don't typically discuss those types of loans because they're specific to they're a specific luxury or amenity to a company or some membership that you have.
So are you looking for like Fannie Mae, Freddie Mac?
Yeah, no. I was going to go into so basically we have your traditional FHA for some home buyers, low down payment options. With VA obviously is a vet. The requirements for that are 3 months of active duty service post 9/11. After well, I think it's after that's not even accurate as well, but basically 3 months of active duty service and anybody who's been in like the last 30 or 40 years meets that requirement for the most part. There are some intricacies to that, but they needed to be active during a wartime. Um, at the very minimum, at the very minimum for the 90-day thing to work out. Basically means you need to go to basic training. And then not get out with a less than honorable discharge. So, but okay, so here's kind of what I was going for. So then there's also private loans, and
Can I ask a
private
question?
loans, and so can
Tristan, can I
be
ask a question
hard
regarding
money.
that?
They can go ahead.
Can I-
I'm sorry, I heard. Is that okay? Anyway, so there's also private money because there's private lending. So there's not just big government-backed, government insured loans. There's also private lending loans. So those can be institutional investors being backing some side of program or some company. There's DSCR, which just means which is how commercial loans are done, but also on the residential side, they are investment properties. So basically anything that debt services. And to debt service, and what they say is usually 1.25, means that the rents received must be more than the mortgage payment. And
Can I
so a
ask
good
you,
example, go ahead.
I'm sorry, Tristan, is
No,
when you said
interrupt. That's what yeah, I'm gonna burn out real quick. Say that
is
again.
DSTR and DSR the same thing?
No, DSCR.
DSCR, okay.
And it's debt servicing. It's just a shortened acronym for debt servicing.
Tristan,
Yes.
so back to the VA. So say they went through basic training,
Mhm.
and then after basic training, they were found to be medically unfit.
Mhm.
Do they still qualify or do they
Yeah,
not?
absolutely. So that's called a medical discharge. And
Okay,
that happens really often. And as long as as long as it's a honorable discharge and a medical is considered honorable, they still qualify.
I have a question for
Okay,
you on
thank
that. Is the debt to income ratio the same on like medical disabled money you receive from the military? Because I know it's non-taxable. So is the debt to
No, okay, so
ratio
that's a great question. I think what you're trying to say is there any type of uh, exception or incentive to that program? Yes, because a lot of times, for example, right now, I think 100% disability from the Air Force, which a lot of people gets you, or excuse me, the military is like 37 something a month.
yes.
We're gonna round it up. We're gonna round it up to 4,000 just for easy numbers. So because it's not taxable, and this is the truth for anything, alimony payments that aren't taxable, um, anything that's not taxable, and I mean, there's per diems for I mean anything that comes in untaxable, we get to do what's called grossing up, and you add 25% to that. So if they're receiving $4,000 a month in disability payments that are non-taxable, we gross that up to $5,000 of eligible income. And by grossing that up, basically what you've done is take what a traditional person would net So traditionally, if somebody makes $5,000 and they pay 25% taxes, you know, they're netting $4,000. It's go backwards there. But so when we gross that up, we're taking $4,000 of non-taxable income, and for debt to income purposes, we're turning that into $5,000. And we do that for both BAH, which is the housing allowance for military. We do that for BAS, which is the food allowance for military, which just went up also. And then we do that for VA disabilities. And then a myriad of other things. Like I said, an easy one. Another one is alimony. If you're receiving alimony and you don't pay tax and it's tax free, we gross that up as well.
What about child support? If for
Uh,
someone who's got like a 4-year-old, you know, and expected to receive it for, you know, to the kid's 18.
yeah. We can utilize some of those funds. We need to have and we'll get to things like that as well. But that's a great question. So we have to have a divorce decree with a summary, and we need to know that they're going to receive that for at least another 3 years.
Okay, thank you.
Yeah, and then that's true of most things. The thing you'll find in lending, especially the type of lending that we do, there's tons of great lenders and stuff, but there's just different types of lending. Is that there are rules, and there are rules that can be bent and broken. And there are federal guidelines that cannot be broken, and then there are bank guidelines that absolutely can be bent, and in some cases absolutely just broken. We ask for exceptions daily. I mean, I bet Trinity will tell you, but we're probably 80 to 90% of the loans that we're doing right now, those buyers did not meet traditional eligibility, and we asked for exceptions and went around. And when we hit the roadblock, we didn't just say, hey, sorry, you don't meet this, you don't fit it in this hole, you know, you're a square peg trying to get into a circular hole. We asked for an exception, or we hunted banks down, or some sort of program that would allow, because they're funding it using their own money. So if they choose to take that risk, they can do that. So we get exceptions to those things all the time. So debt to income is one of those things. All kinds of little requirements are you know. So anyway, so let's just say so the main 3 things we're going to talk about today, but I am hoping that we will get into other subjects and you guys will ask other questions. Are FHA, VA, and conventional. That's what you're going to see in residential home loans more often than not. Let's see.
Can I ask you one quick question?
Absolutely, please.
Trystan, thank you. What can you just name the loans that you provide, your service, just so that we know?
Oh goodness.
I'm assuming
If it exists,
you guys
I
do
can
the
do it.
DSCR and you
Yep.
do the
So we do hard money, DSCR, bank. So we do bank statement loans, which just means, you know, and that mostly is entrepreneurs that don't fit into that. Okay. Realtors are a great example of this, actually. Realtors and any contractor or anyone that owns a business, and every one of you owns a business, we make as much money as we can and we spend as little as possible, meaning we don't like to pay taxes. That's an example of things we don't like to pay. So we will expense as much as humanly possible and try to get our tax bill as close to zero as we can. That's phenomenal. But the way that hurts you is now you have no eligible income for loan purposes. So what a bank statement does is, if somebody is habitually and consistently making deposits into a bank account, we can utilize that bank statement. We can't do 2 months like we normally do. We have to use 12 or 24 months of bank statements, and then we average out those deposits. And that is the income that we use as eligible income. If we do it for a business, let's start with personal. If we use a personal checking account, let's say they're the sole proprietor of their business. Most of you are more than likely sole proprietors. We get to use 100% of those deposits. If it is a business account, it is actually a checking account, and you had to use an EIN number, and it's tied to your S Corp or LLC, we get to use 50% of those deposits because they assume that there is an expense ratio in there, either a product or whatever the case may be, payroll taxes, something.
So are you saying that if I have a personal account and I deposit a check in there for $15,000 every month, even if I spent all of that 15,000 or I withdrew it,
Mhm.
you'll be able to essentially use $15,000 for my income if I could show that for 12 months?
Yeah, 24 is better. Yes.
Okay.
Now, with that, there is going to be some other things. If you're showing deposits and there are no, like, the bank specific, so the answer to the question generically is yes. Specific banks will then go in and say, okay, well, what's up with all this? Where's the money going? Okay, we're
Sure.
moving it
Yeah.
somewhere else. So we're
Yeah.
spending it, we're living on.
I-
Okay, great. You're living on it. Okay, perfect. So we may have to write a letter of explanation why you are maintaining a zero, why every single bank statement has a zero account balance on it.
And I was just exaggerating that.
Right, exactly. But people are living on these funds, so that's kind of the point. As long as you are showing consistent deposits and you are putting down enough money to make them feel comfortable about the collateral, yeah, that's the generic answer. And we have so many banks that do that that I can't give you a specific answer for what the requirement would be for that. We have a lot of
But
banks
banks
that will
can,
do. Go ahead.
but banks are willing to accept that, and then you don't have to provide your taxes showing all your write-offs. Some
Uh,
possibly.
Possibly. A lot of times we still have to show bank statement. I mean, excuse me, tax returns.
Okay.
But and not in every case. Not in every case. If there's something funky they want to see, we try to withhold whatever we can, to be honest. So um but yeah, absolutely. Like there are times that we just give them as little as possible. A lot of times we do need tax returns so that they can confirm that you are at least in with good standing with the IRS and things like that. It just depends. Every scenario is different because there's a million different scenarios under that. We can even do DSCR for owner occupied. We're doing several of those right now as well. So I use
Oh,
the
wow.
example. Yeah, I mean, but it they're you're not going to get it done for 5%. They were doing it for 10% until pretty recently, and now most banks are requiring 15 for owner occupied, 20, 15 or 20 more than likely for investments. But if you're a entrepreneur like we are and we write everything as much off as we possibly can, it's a great option. Interest rates are higher. You don't want to stay that in that loan forever if you can help it. But a way to combat the cost is to go interest only. And if you are looking for cash flow and trying to leverage a property because you're expecting appreciation, you don't really care to pay if you're only paying interest for 3 years. Because most of the time on a amortized loan, you're paying mostly interest up front anyway. It's not until later in the loan that that you're actually digging into the principal of the loan. So the thought process is, okay, I'm restructuring. I'm doing my business, all this. I'm trying to make as much money as possibly can. Later on, I plan on paying more taxes and actually being a little more profitable on paper, whatever the case may be. But I haven't done that, or I'm willing to do that now. I just haven't done it in the past. Okay, great. So let's do one of these options. These we call them non-QM, non-qualifying mortgages, because they're non Fannie and Freddie qualifying. Is why they're called non-QM. We will go into one of these loans thinking it's temporary. Okay, when April comes around, I'm going to file my taxes and I'm going to claim income this year, and I'm going to do it maybe next year. It might take two. It depends on, but and then we can refinance you into a whatever the loan of the day is, more than likely conventional at a much more desirable interest rate. Payment's probably going to be pretty similar though, because in the conventional loan, you're amortizing principal and interest, whereas in the non-QM loan, you're going to be paying interest only at a higher interest rate. Any other questions on that? FHA, what do you guys know about FHA? Somebody throw it out there.
Low down payment and credit can be lower than ideal.
Yeah. What's the minimum down payment?
3.5%, but
Yes.
Yeah, I've heard some people do 1%, right, with some of the programs, right? Or
Yeah, so there are grant programs available. There is I call it if you fit into the narrow scope, this needle, meaning if you make enough money to qualify for the house, but you don't make too much money to not qualify for the program, so you're right here in this spot. Yes, absolutely. There are programs, and we have lots of different grant programs that sometimes have funds and then they run out, and most of them are government sponsored. CalHFA is the big one everybody hears about. Um, yeah, absolutely. We have grant programs for those kind of things, but all those programs do is help you get funds to cover the FHA uh, minimums, and the minimum for FHA is 3.5%. In and then so 580 minimum credit score. So here's where this kind of gets interesting. So yes, 580 is the minimum credit score for the federal guidelines. Will most banks do that? Most are not interested in that right now. Some will do it, but they're going to penalize you via the rate in some shape or form. Or the other thing is, if you have a 580 credit score and and you have a decent reason, like something has happened that is explainable and temporary, and nothing else is wrong, you don't also have crazy income issues, or there's not all these other things. Oh, you have savings. But and so banks will make an exception to lots of little things like that. But if you are showing high risk in multiple categories, these minimums are a little bit, I don't want to say false advertising, but they're almost too good to be true, because they're not. Most banks, most people that have a 580 credit score, this is just most people. I'm using statistics here. Also, don't typically have $40,000 in the bank, or they would have used that to avoid doing whatever happened to their credit. So, gift funds. Gift funds are great. Man, that's phenomenal. What you want to be careful for with gift funds, though, and something to always disclose, because that's what we're doing here is getting you guys as prepared as possible to have conversations with your clients, not give them loans and not give them legal advice or finance advice, but to be able to have these conversations with them. And so really early on, if you have a client that says, hey, my grandfather's going to give me money for this house, man, that is fantastic. Congratulations. Do me a favor. Don't let him move the money around, and don't let him give you the money. Don't let him wire you funds. Don't let him write you a check. Don't let him do anything. Have him sit on the funds until your client, and possibly more than likely the grandfather, who's going to have some concerns before he just wires a check off, is going to want to have to talk to somebody to get comfortable. Make sure they don't do that. Make sure they don't do anything. Make sure they just have a conversation with us. We'll give them the right way, but you'll want to make sure that they know that the family member is going to wire those funds directly into escrow to avoid any kind of convolution or issues that then have to be tracked. Because if it gets bounced around and there's multiple family members wiring money in and they're depositing to your account, it's going to get really complicated really quick. It could blow the loan, because the bank's going to say, okay, I want bank statements from every person that's touched this money. And then they're going to go through those bank statements. And then if they see money coming in and out that's unexplainable, they're going to want that money tracked. And we're going to have, so it creates a really convoluted, ugly family tree that we would really rather avoid if we can. The cool thing about FHA also is debt ratio requirements are more of a minimum guideline. If you've got, if you've got a 50% debt to income ratio, meaning your mortgage is going to be $2,000 a month, and your income is only $4,000, you no longer qualify for conventional. But we can still get you an FHA. I mean, we're going to creep that up, as high as we can get it, and then we're going to keep submitting it to banks until this bank says, yeah, I'm in until 55. This bank says, I'm out at 55, but this one's like, I'll do 56. So okay, great. So that's another thing that's really, really great about FHA is we get higher debt to income ratios. And there is no really straight answer, which honestly for us makes giving pre-approval for the max a little bit more complicated. When people are like, give me as much money as I possibly can, we actually have to make a judgment call on that. You know, we use we talk to different banks and we'll run programs and stuff, but that makes it a little more complicated because we actually need to put it in front of an underwriter and just say, hey, listen, this would you be willing to grant us this debt to income ratio with this credit profile and this income profile? Yeah, we'd be willing to do that under those circumstances. Okay, great. Now we can issue a pre-approval letter. Whereas, you know, some other things, it's a cut and dry for us, and it's like, oh yeah, we do this all the time. We'll stick it through desktop underwriting, or we'll just look at it and say, yeah, absolutely, that meets all the requirements. Any other questions? Okay, we're gonna move on because, like I said,
Can you explain desktop underwriting?
Yeah, absolutely. So desktop underwriting is basically we put an entire file together, a program, and desktop underwriting is not something that we can do independent of banks. We have to use the desktop underwriting program that has all the guidelines that each bank has put together. So I may have to run it through, let's say I have a more complicated file, and I have some questions. I'm not sure if it's going to fly or not. And now keep in mind, you don't get to like explain things away in this. It's very, very data driven. But using some of those examples, debt to income's super high, credit's a little low, or it's in the, you know, there's some of these things. So each bank has programmed their own software, their own underwriting system, desktop underwriting system, to meet these, to allow certain guidelines and combinations of low and high and good and bad. And so if we run something through the desktop underwriting, it's so that you don't have to take the time, put a file in front of an underwriter. The underwriter has to go through it. They look at it and they have questions. They come back to us. If something, and those are, so if it meets desktop underwriting, they honor it, because those are not the extremes of what they will allow, but it's getting up there near those. Anything more extreme than what's allowed via desktop underwriting is going to require a bank's underwriter to individually underwrite that. Everything else is kind of blanket underwritten based on guidelines. But each bank has different limits that they've put into their DU programs. Does that make sense?
Yeah. Is that so what's the difference between that and a TBD approval besides
TBD is just address.
So do you put a TBD through desktop underwriting or does it go through a full underwriting?
Either, but we can do TBD either way. So the TBD is specific to, it means that we are underwriting the individual, but we are not underwriting a specific property. So all we're getting to do is leave out the address, because now the only issue, typically the only problem that could come up with that is they are using a traditional tax, property tax. So let's say that you underwrite somebody. For example, most property taxes in the county, it's like 108, but most of the time, property tax in Vacaville is, let's call it 119. So 1.19% of the purchase amount, the assessed value annually. The problem with that, if we run somebody through so if we run that TBD, the problem with that is they have not looked at the property and the property's property taxes. So if it's one of these areas that has Melrose, or in Rio Vista, they've got all this extra PD and FD and riverfront fees, and they just recently did took a bond from the government, some sort of loan. So now there's like a $900 bond payment everybody's paying every year to, in addition to their tax rate. So there's all these extras. DU doesn't take that into consideration. So there is the risk or complication therein. So, but if, for example, typically when you run DU, you're running it at about 1.25, which is actually higher than, in fact, most circumstances, banks, we are pre-approving loans based on a 1.25. We're estimating the property is going to have the property taxes annually at 1.25, and Typically, it's less than that, which is nice because not only are your upfronts lower when you come to closing than you expected, your out of pocket's a little less than you expected, but also your monthly is a little less than you expected.
Tristan,
Yes.
is desktop underwriting, I'm assuming it's DU for short.
Yes.
And then there's no direct underwriting. That's like not a correct term. It's just desktop underwriting.
It's
The reason why I
it's
ask is someone put it in their MLS that we have to send that with the offers. So
yeah, no, that's not unheard of. And we can do that. So when we submit something to desktop underwriting, it prints out a summary that basically says whether or not it's approved. And it gives us some plot points and some questions and potential conditions under that. But yeah, that's an easy, we can do that. And when I say we, I don't mean me, Trystan, or Brickhouse Mortgage. I mean with lenders, we can do that. Like, and that's not unheard of.
thanks.
VA. So what do you guys know about VA? Let me throw some stuff out there. What have you heard? What have you dealt with yourselves? Okay, what's the
One thing I would like for
benefit?
you to clarify with the VA is the whole I don't know, sometimes like can people just buy as many VA homes as they want if they don't have, if they sell one and they buy a new one, sell one and buy a new one, can you end up buying, can you use your VA 5 times, or
Yes.
are there limits?
Absolutely.
Okay.
Yes, you can. There are exclusions to that. But we're going to be very generic. Yes, you have the benefit of, due to your service, that you have access to these VA loans, which is still a bank loan. I had a weird, I've got a call this afternoon with a client that just that wants to bring their husband doesn't understand. So that the question that I got over the weekend was, if I have a VA loan, why do I need a pre-approval from you before the realtor will show me houses? Okay, well, that's simple. The VA is guaranteeing your loan. They are not funding the loan. A bank is still funding your loan, which is why you still have to get a pre-approval from a bank, and we still have to run debt to income ratios, and they still have to determine whether or not they are personally willing to lend the funds. The reason that they are willing to take a little more risk on VA loans, offer a little bit lower interest rates as an incentive, allow the debt to income to be a little higher, is because the VA has insured that loan. If the loan defaults, the VA will cover it and make the bank right. So there's a lot less risk to them in that. The couple of things. If you, and you'll see this a lot now, if you allow someone to take over your VA loan and you move on, let's say that you bought this past year and now you have to move and you've got some negative equity in the house, and you really want to incentivize somebody to buying your house, and you're saying, hey, come in, buy this house, take over my VA loan, it's at 2.5. Wow, that's great. What a lot of people don't know, and we can go over the cons of doing that as well on the other side, but what a lot of people don't realize is that you have now given up your VA eligibility and you've given it to a non-vet. You've given up your VA eligibility. And so until they refinance or sell that property, you don't get to use it again. The downside, another downside well, I wouldn't say downside. The take in that scenario is where you would buy a VA loan, sell using a VA loan, buy using a VA loan, sell using your VA loan, is that after the first use, there is a higher funding fee. Because so the first time it's minimal, 1.6. After that, it's significantly higher.
1.6 of the amount.
1.6 is the funding fee of 1.6% of the loan amount is the upfront funding fee. And it's kind of like FHA has some upfront fees. And then, and here's the other major benefit. So the two major benefits, what people talk about all the time with the VA loan, is there's no required down payment. You can come in $0 out of pocket. There is a surcharge and some upfront. There's some things that they will charge if you also want to roll your closing costs in it, but we can do it. Typically right now, what we see is people coming in 0 down, sellers paying closing costs. We're rolling the funding fee into the loan. But if you do put money down, you get a lower VA funding fee. And let's say, and then also if you have a lot of vets have a disability rating. You know, you get 10% for tinnitus. People, you get hurt, you get sick, like things happen to you while you're in the military due to your service, and you come out with some sort of VA disability rating. If you have 10% or greater, we get to waive that VA funding fee. When I say we, I get to tell you the good news. It's not really me. The VA is willing to waive that VA funding fee. So now, not only do you not have an upfront fee to utilize the service or to utilize that program, but unlike FHA, you don't have to pay mortgage insurance because the VA is insuring that loan for you. So typically, mortgage insurance on an FHA or a conventional loan that you haven't put 20% down is $200 to $300 a month, sometimes more. So with the VA, you're getting the added benefit of a lower interest rate, no down payment, and you don't have a monthly insurance premium on top of your more principal and interest, PITI, your principal, interest, taxes, and insurance. So VA by far is the best program in the world. It's the best thing out there. I've seen VA loans really give people opportunities that wouldn't have had the chance to get ahead otherwise. You know, especially while they're in service, they buy a little house somewhere. They do their, even if they're not investors mindset, they do their time and they get out and they either have that as a rental or they're able to sell that, take that equity with them to go start their life or to buy somewhere else or kids through college. I mean, so to have the opportunity to be able to get into a loan product where you have 0 down and build equity from nothing is an incredible opportunity. I was given that opportunity, and that's one of the things I'm incredibly grateful for. Go ahead.
Tristan, can I share something?
Absolutely, please do. Oh, Ed, everybody, I don't know if you've met Ed Reposarda. He owns a, I'm just kidding. But Ed, really right up front when I started this thing, I said, you know, one of my least favorite teaching styles is death by PowerPoint. I said, so I've got a PowerPoint here. We're gonna use it as some guidelines. It's gonna be in the background. But what I'm hoping to do at this time is to just have a great real estate conversation. I want lots of questions and I just want to tell stories. I want you guys to tell stories and interrupt me anytime. There you go.
Awesome. So our Kara and my example, back in 21, $1.2 million home, would have never qualified for it utilizing some other conventional, FHA we wouldn't have been part of. So a conventional loan, we would have never qualified. Utilizing VA, have disability on their $1.2 million. The closing cost shows nothing down, $20,000 in closing cost credits because disabled, the funding fee was waived, right? And being in the industry, the commission was $30,000. So they actually paid us $10,000 to move into our home with an interest rate of 2.25%. And it was low, it was like silly not to do it.
Wow. Can I ask 2 questions, Trystan?
Yes.
That's amazing, Ed. Do you, you know that funding fee? Because one time I was working with someone and the funding fee before it got eliminated because they're disabled was going to be $40,000 because it was their second purchase. It was that high. It was like 30 something thousand. If the home, can you guys roll that into the loan, even if it's going to be it's going to be negative equity? So
yes, absolutely. So that's a really cool thing. You're right. Smart. Gosh, you're so sharp. Yes, you're not you're not doing 100% loan to value most of the time with VA loans. You are doing 101, 102% loan to value. So you are technically borrowing more than the house is worth.
Okay. And then just a question for Brickhouse Mortgage. Do you guys do multi-unit VA loans and multi-unit FHA residential loans?
Absolutely. 1 to 4. One of the, so if I'm going to break off of financing for a second here, well, sort of, and get into like personal. I consistently advise or teach or try to tell people or convince people to utilize, if they are investor mindset and they're looking to build, you're looking to grow net worth or portfolio, and you just don't know where to get started. Use your first time home buyer benefits, use their VA, use a VA, use a FHA loan, hell, use a conventional with 3 or 5% down. And any 1 to 4 units is considered a residential home loan. So you can put, let's use an example. Let's say you found a fourplex that you really wanted to buy, but you've never been an investor. You want to start building and want to start growing. You could, you found a fourplex for, let's say, $1 million, because I don't know. You could put $30,000 down as a conventional loan, $35,000 down, and move into a fourplex, live in 1 unit, receive $2,200 a month from the other 3 units, $6,600 a month, to cover most of your payment, live free, and start building net worth. It's a phenomenal, absolutely, yes.
So if you are going to put 5% down and it's going to be your primary residence, and you're going to go conventional, but as low as 5% down, you can still get a loan for a multi-unit?
Yes.
I
1
didn't
to
realize.
4 units. So 1 to 4 units. So let's talk vocabulary real quick. 1 to 4 units is considered residential for all intents and purposes. It is multifamily, but it's considered residential. 5 units or more is considered a commercial building. It no longer is eligible for residential financing, and it doesn't meet all the different conventional Fannie Mae and Freddie Mac guidelines. So that's when you jump into traditional commercial financing, which is like DSCR, debt servicing. Like the rents would have to cover the mortgage plus. And they would not want you to move into a unit.
But don't they have to occupy one of the units?
For residential, yes.
Okay.
And you guys
there
also
are
do
exceptions. Fannie Mae does not allow. So I've had a client recently want to do the same thing. Wanted to get going. Wanted to live in the unit, but she was trying to buy, and she wanted her parents to co-sign. Well, that's all great but now you've got 50% of the applicants. Actually, in this case, 66.67777% percent of the applicants of our eligible income weren't going to be moving onto the property. Fannie Mae does not allow that. Freddie Mac will, though. So we were able to get an exception. She, honestly, it's pretty impressive. Kimberly was her realtor. She bought a fourplex. She's 25 years old. Her parents co-signed for her. She moved into one of the units, collecting 3 rents from the other 3 units, and she needed their income to help her qualify for it. Because in that some circumstance, though, you have to be able to qualify for the entire property. We can't use rents to offset, because it is a residential primary home loan.
And can
But
you
it's absolutely brilliant. Absolutely brilliant.
Now, can you use VA to qualify to do that
Yes.
as well?
Yep, absolutely. 1 to 4 units is residential home loan. So you can use any residential home loan to do that, as long as you're moving into one of the units.
Trystan, may I ask you a question?
Yes. Hey,
And
how do I
I'm
see all the people? So I'm not technical logically, but how do I see everybody who's on here? Because I didn't even know you were on here.
Go up on the top right where it says view,
Okay.
and then click down the view. You can do side by side or gallery. Do gallery.
Is that in more? Carly, no. Is it? Oh, okay. Under participants. No, wait, or something like that.
I'll come help you.
Never mind. No, 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 no. It doesn't matter. It's okay.
I was gonna help you, but it was your.
Oh, hey.
Okay, can I ask my question?
ask the
Not
question.
because
Ask-
I'm your wife and it's my duty to question you.
100%.
But I'm just curious. So I was under the assumption that the VA funding fee is 2.3% if your down payment is less than 5%.
Mhm.
And then therefore, anytime after that is 3.6%. So did that change
Nope.
or
No, that's
it's
no.
always been 1 point whatever you said?
Yes. So if you put 5% or less down, 1.6. If you put 10% down, it drops to 1.3.
Okay.
Hey Ed, my digital assistant has just showed up to show me how to use technology. Sorry.
Tristan, I'm sorry if you already answered this, but you said that
No.
Brick House does do the um 1 to 4 unit low down payment, can do low down payment, like 5% down on a 1 to 4 unit for if you're gonna live there.
Yes, absolutely. Absolutely. We can do 3%. So if you're getting going now, the caveat, not caveat, it's not a caveat. Something to consider is you do have to have pretty solid income. So if you are, early in life, or even not early in life, but if you're just getting started, it can be a little difficult to qualify for all 4 units, because you are adding to the cost.
But
Overall,
you can use the residential income though, right? You can use a certain percentage of it, or
no, not for that.
oh,
No,
only for
So you-
FHA and VA, or none of them?
ask the question again. So
Okay.
we understand.
I'm so sorry. I was
No, no,
just
no.
wondering, to purchase a 1 to 4 unit, if someone wanted to purchase a 1 to 4 unit, putting the minimal amount of money they can put down, they're willing to live in 1 unit.
Mhm.
Can they utilize the
Income to
income from the
offset?
other 3 units?
No.
Yeah. to them.
No,
Oh, wow.
not in that scenario. No. There are times you can do that, but this is not one of those. I mean, yeah, no. You have to the caveat is that you have to qualify for the entire mortgage. But if you can pull that off, you have high income and are trying to build up your portfolio and get started on your investments, and you're trying to determine whether you're going to buy a house or something to live in or something to rent out, buy 4 units or 2 units or 3 units. Absolutely. But you have to qualify for the whole property, the whole building.
Can
If you
you
wanted
have,
it now, you could do an investment loan instead of that, and utilize those incomes. Absolutely. And there are some weird hybrid programs and stuff, but you're not going to be able to put down 3%. You're going to have to put down, your loan to value is going to have to be lower.
can you
Probably.
have two
Yes.
VAs? Can you have two VAs doing the same partner and the same loan that are not related, but are going to live in, say, 2 of the units?
Yes, that is a great question. So the traditional answer is absolutely not. Most banks will not do that. We do have some banks that will allow it, but you will split the benefits. You will only get so let's say you and let's say a borrower and their partner want to buy using one of the members, one of their VA loans, because let's say one of them is a vet, but they're not married. You would only get half of the benefit, meaning what I mean by that is you would have to, so okay, so VA eligibility guidelines have changed, so I'm going to go backwards a little bit. Traditionally, until just recently where they've raised this, anything over the VA loan limit, you had to come up with 25%. I'll give you hard numbers. When I bought my house, it was an $800,000 purchase price. the VA loan limit at the time was 500 and something. And so I got 0 down up to, let's call it 550 just for ease. I got 0 down up to 550. But then I had to come up with 25% of the difference, which was the 250. So I had to come up with 25% of 250. So so now that is now lifted. I could have borrowed if I was buying the same house today, I could borrow the entire 800,000. What has not changed is that that 25% is still in there somewhere. They still consider that the VA traditional down payment, which they waive for every single VA loan. Now, if you and your partner who are not married want to utilize one of your VA loans to buy, and only one of you has VA eligibility, you would have to come up with 12.5% down. So you might ask, well, shit, why would we do that instead of doing conventional with 5% down? Well, that would be up to the scenario and you personally, but with VA, you get a much better interest rate and you don't have to pay mortgage insurance or MIP, a mortgage insurance premium. So whereas if you went conventional less than 20, you're going to pay that. Unless we have some banks that will allow us, as long as you put 10%. See, I don't want to get into nuances too much right now. There are nuances to that. If you take a higher interest rate, some banks will allow you, will buy that for you. They will not make you pay a mortgage insurance premium, but they're going to give you a higher interest rate, and you got to weigh out what's better for you. How long do you plan to keep that loan, and when will that actually pay off some of those costs? Let's see. What are the other requirements for FHA loan? I mean, we'll call it a con, but it's not really a con. What's another requirement of the FHA loan? VA loan that is not required for most loans. Does anybody know?
Sometimes a pest clearance dependent on the
Pest inspection. Yeah, absolutely. Every single VA loan requires a pest inspection. Until recently, we had to have the Section 1 cleared on every single one of those, and you had to have that clearance before you could fund the loan. Now we can do an NPMA 33 form, and as long as there is not an active infestation, we don't require pest clearances any longer. But you still have to have a pest inspection on file that shows that there is no active infestation. Any other questions about VA loans? Throw them out there.
Trystan, I think one of the common,
Hey, Kim.
Hi. One thing I've run into with VA loans is that people think because they don't need any money down that they don't need any money at all. And I think, is there ever a time that you don't have to put down an EMD with a VA loan? So
that is a,
that.
I respect the question. I respect you greatly, but that, I think you're messing with me because that is not a lending question. That is a brokerage question. We do not require, the lender does not require, she's trying to hang me up. The lender does not require EMD. We have no dog in that fight. So the answer to the second half of your question is no, we don't require EMD. I guess it I guess the determination on whether or not you need any money at all would be how good your realtor negotiates for you on your behalf. Because keeping in mind, you will probably need funds for closing costs unless you're upfronts, unless you get a credit for it. You will more than likely, this is me stepping out of my lane for a second. You will more than likely need money for inspections, and we can put off the appraisal. Like, we can cover your appraisal for you and you can pay it at closing if you're getting closing credits from the seller. But other than some of those little niche things that the costs that come along with purchasing a house, other than the traditional closing costs and down payment, no, you can, I mean, the bank is going to analyze that as a risk, and that's going to go into the total profile. When they're profiling the risk of your file, they're going to look at that and they're going to say, hey, why don't they have any money at all? But a lot of times, right now, especially, a lot of times we're giving people loans that have $1,000 or $2,000. And they're getting a $10,000 or $11,000, $10,000 seller credit. They're putting $1,000 down EMD. We're getting that credit, and so we're covering the appraisal, and they're going to pay it in escrow. So the EMD is going to come back, cover the appraisal, and what other little bit of costs aren't covered in that. And then the funding fee, we either waive it if they have a disability rating of 10% or higher, or we roll it into the loan, which just means they have to, and which is standard actually. We don't even ask that you want to pay your funding fee out of pocket. It is standard to roll the funding fee into the loan. They do have to qualify for the additional cost. For example, we don't qualify them at 100%. DTI based on 100% loan to value. We qualify them at a loan to value of 1.2 or 1.3 or 1.6 or whatever it happens to be.
And I think to answer Kimberly's question, there's 5 elements to a contract, and number 3 being adequate consideration, and that is part of the adequate consideration. So the EMD, the initial deposit, is a good faith moving in the contract for that adequate consideration. It can also be a promissory note to give you my car. It can be a lot of different things. It doesn't have to be cash.
That was a really great question, Kim. I was messing with you, but that was a great question because it brings up some of these things we get to talk about. And that's really what we want. We want a really great real estate conversation. And we want to make sure we're including some of the basics of financing because, like I said, it's not your job to know finance and to know every aspect of loans. You need to know enough to sound credible when you talk to buyers and give them confidence, and then also have good resources to get those answers. Because honestly, if you overspeak, you could hem yourself up and end up in a corner. You said this. Yeah, but I shouldn't have. Any other questions about VA? All right.
So it sounds like they have to give you that discharge document before you can, as part of the, I'm looking at the
DD-214. Yeah. So you get issued a DD-214. If you're active duty, you get a DD-214 when you separate or retire. If you are reservist, you get a DD-214 every time you come off active duty orders of 30 days or more.
Okay. So when you're qualifying them, they need to hand you that as part of the
No, they don't. I don't need that. I think they used to ask for that, but we don't actually need that anymore. We can look all of that up now.
Okay.
We directly go to the VA on your behalf or the borrower's behalf and pull their certificate of eligibility. And it very clearly states all the information that we need, and if they're eligible and if they're not, or if they are only partially eligible. Let's say they have, and I don't want to dig into this too much because there's some gray areas here. We don't run into it in this side of the country very often, but you can have 2 VA, 3 VA loans at once. There's nothing saying that you can't have multiple VA loans. There are just limits to that. And one house in California gets right up to that.
So
Darn close.
That's a question that I have. So when you pull someone's eligibility, it's based on amount.
That's where I would say yeah, there is an amount. I can't tell it to you because it is I've thought I've understood it multiple times, and then they've done a weird calculation and they didn't give us credit for what I thought they should have, or vice versa. I've been shocked a few times.
Okay.
So there's a weird calculation that they do, and no, us mere mortals don't understand. So, but yeah, absolutely. We see it all the time where somebody will be moving from Florida. They'll be PCSing here from Florida, and they'll have a house that they owe 110 grand on, or 150,000 bucks. And it's like, yeah, we can get you another VA loan, but I need to get the calculation done. I need to ask the VA to determine how much you can borrow. And we do that.
But let me ask you this. So whatever income you have, and let's say your max amount today is you can purchase 800,000. You buy that house, sell that house. Does that mean that you can always, you can buy another $800,000 house, or do you lose some of it and you can't buy that?
You lose some of it. You lose some of your, you lose some of your eligibility. Yeah, absolutely. There is a value. There is a number. There's an absolute cap on how much VA you can. Now, if you're just buying one house, there's really not. They've raised that. or they give you exceptions. Now there is a traditional VA loan and then there is the jumbo VA loan, but there is now no limit, which is why and these are all new guidelines and new requirements. And we're having to read through this, not just for this type of loan in this bank. I mean, all the time, it's changing every day, all the time. And there are still some weird gray areas, but yes. So now they have raised the limit for what you can use a VA loan to purchase. But they have also, so it's weird because they have waived that. So it's like, oh, wow, then I should be able to borrow a couple $1,000,000 for a VA loan. Well, yeah, actually you can to buy one house. But if you try to do multiples, there is still this value that's left over from the old VA loan, VA eligibility requirements. And so that's why there's no number I can give you, because there is this calculation. But yes, there is a cap on how much money they will loan you to buy 2 VA loans. If you have a loan for $600,000 in Florida and PCS to California, you're probably not going to get another $600,000. But if you have $100,000 or $200,000 loan in Texas or Florida or Oklahoma or Arkansas, Amy, and you move here, you probably still have eligibility. No, you do. You still have eligibility. We just have to help figure out and determine how much it is. It might be 500,000.
Trystan, how does VA and FHA assumable loans work?
Okay, so good question. When you assume, and I did touch on this early on, but when you assume a loan, so okay, I'm going to double down here. So go ahead and assume that every VA loan is assumable. Don't assume any other kind of loan is always assumable, because that is on a independent basis, whether or not each loan has been determined. Like a bank will determine whether or not it is assumable or not. VA loans are always assumable. Benefits to that, obviously, we've touched on, is if you really want to sell your house and you have, and you really want to incentivize somebody to purchase your house, you're going to offer up my assumable loan at some incredible interest rate. They can take it right over and move in. Awesome. The downside of that is you either have to, because I mean, fate would have to be a funny creature it would just have to be insane for the value of that loan to be exactly what you owe on that house, what somebody's buying that house for. I mean, it's pretty rare that there's not like some equity going one way or the other. So let's say it is even, though. You are now allowing somebody to assume your VA loan to get a better interest rate. You have now lost your VA eligibility until they sell or buy, or they refinance or sell that house. So there's the downside on that side. On the purchaser's side, everything sounds hunky-dory. This guy's going to sell me his house for, say, $600,000, and he's got this VA assumable loan that I'm going to take over, and I'm only going to have to pay 2.5% on my loan, and the interest rates are at 5 1/8 or 5 1/2 or something right now. Well, he's selling it to you for $600,000. You have to come up with that $100,000, and if you don't have $100,000 in cash, you're going to have to get a bank to agree to give you a second. And most banks don't want to be in second position, especially on a new purchase. You could do it, they'll do it, but they're going to charge you a premium, and so you're going to end up with a 2.5% loan and an additional 9 or 10% loan, more than likely. And so you have to do the numbers and figure out, is that worth it? And where's that number? Like when is that worth it? And does the pro way outweigh the con there? So that answer the question. Is there more? You want more out of me? Randy?
No, you're good. And FHA loans can possibly be assumed.
Yes.
It just depends on the bank, right?
Yeah, it depends on the loan itself and how it's written, how the loan's written. You can do this on any loan. You can call and find out if the loan is assumable. Some banks allow it, other banks don't. Most banks do not allow assumable loans because if their interest rate's gone up, they want a piece of that. They don't want to continue to receive. They don't want to continue to lend their money at the interest rates from 2 years ago. They want to step into today's action. because they're borrowing at one rate and they're trying to get rent at a premium or reloan that money at a premium to make a margin. But now they're borrowing money at more than what they've loaned the money to that borrower for. So now they're losing money on that loan if you look at it in that way. So hell yeah, they want you to refinance or sell that house so that they can reloan that money to somebody else at a much higher premium. So more than likely they don't want you to do that. They're not gonna let you do it.
And when you say they, it's the seller's responsibility to call and make sure the loan is assumable. Like I can't just call on behalf of my client and see if it's assumable. Does the seller have to do that?
I would say the seller would have to do it or give you permission, and in most cases, they're still not going to do it. I would say the seller needs to do it at first, and you certainly need to confirm. But you would have to have the seller tell the bank to allow you to have that conversation, or to have them to reach out to you. They would have to give a contact. But yes, the seller would need to have that conversation with their bank and then market that. Moving on. Anything else? Anybody have good stories on VA loans? Or any funny something? Anything pertaining to VA?
Well, you were talking about multiple loans. I have a client and a friend. She actually had a home in California. She got PCS to Florida. She rented, and how she did it was because I was asking her, I knew I was helping her a little bit, but she did it with the base to where they would rent out her house, and that was guaranteed that they would rent out for such a time. So then she bought her house in Florida. Then they PCS'd her. She did the same thing in Florida. Then they PCS'd her to Texas last year. And so she's actually got 2 rentals, one here in California, one in Florida, that are still on her VA. And she used her VA to buy her house in Texas.
Nice. Yeah, it can happen. That absolutely is allowed. It just happens. It really determines, it comes down to what the VA will determine is your max eligibility. And so if the houses are inexpensive enough or the loans have gotten low enough, you still have enough in there to do it. They did bring up you did remind me of another good point. I don't know. When you can absolutely use rents to cover previous mortgages in order to qualify for the next mortgage. And that is also VA. So, and we see it all the time. So basically, especially if you have, whether you use your VA again or you use a different type of loan product, if you have a VA loan somewhere, you get moved somewhere else, we can use market rents to cover that loan. More than likely, you're going to have a lease by that point, but we can absolutely use market rents, and there's a formula there, to cover your previous mortgage in order to get you it doesn't give you more VA eligibility, but it will clear your debt to income. We can remove the previous mortgage from your debt to income calculation. But that's a great story. That's awesome. That's one of those scenarios where that works. And she was able to buy 3 different properties, 0 down. She's probably going to retire a fairly wealthy woman with very little work and very little side investments, which is pretty cool.
Trystan, if husband and wife are military, can they
Mill on mill.
combine it? Is there a benefit to that or no?
Yeah, no, absolutely. If you're mill on mill, if you and your spouse are both military, you have 2 VAs. I would leverage those any way you can to stack and get as many loans as you can with it and benefit. A lot of times what we see people doing is, using a VA loan, renting it, buying it with another VA loan over here, or a lot of times we have to, unfortunately, let's say you've been PCS somewhere for 5 years, 10 years, you have a ton of equity in the house, but you have a great interest rate. If you don't have any VA eligibility left, you either have to buy using a conventional, or we have to refinance you using a conventional, in that loan into a conventional loan in order to get your full VA eligibility back. to buy the next house. But if you have two VA loans and you buy an $800,000 house on the beach in Florida, and then you move to California, you have a second VA loan. You could, if you want to buy $1 million house here using that VA loan, you absolutely can. And any combination of stacking and half uses and that you can. Here's the kicker on VA, something to keep in mind. With FHA and conventional loans, a lot of times what we will do is we will put the loan in one party's name and get to just add the other party to title. Let's say they have bad credit. Let's say you and your spouse are buying a house. One spouse has a good job, the other has a decent enough job, but their credit is not bad. If we can cover the mortgage with the first spouse, we'll leave the spouse with the worst credit off of the loan, and we'll just add her to title later. We can't do that with VA. With VA, they require everyone on the loan, or they require husband and wife. We require 2 credit profiles, or both to be ran, because you're responsible for your spouse's debt. And unfortunately, on every loan, if whoever's on that loan, we have to use the lowest middle score. So you have 3 credit reporting agencies, and we have to use the middle score from each. And if you have 2 parties, we have to use the lowest middle score. So I'm going to give you an example of that. If the husband's credit is 630, 635, and 640, the wife has 780, 790, and 810. Unfortunately, we're using a 635 credit score because it's the lowest center score. We got conventional loans. Conventional loans is your typical Freddie Mac, Fannie Mae backed government conforming loan. Interest rates are a little higher. You can do a myriad of different things and products that are still going to be covered by Fannie and Freddie. So where do we want to start with conventional? The conventional wisdom says with a conventional loan, you put 20% down and you buy a house. That is the truth. That is an answer. But conventional loans also offer, you can do 3%, 5%, 15%. These are all funded by banks, but they are typically insured or purchased by the government, by Fannie Mae or Freddie Mac. And so most banks, they want their loans to be eligible to be purchased by Fannie Mae or Freddie Mac. And so Fannie Mae and Freddie Mac are involved this could get really, really complicated. So I want questions galore, but let's try to keep it in a semi-narrow, understandable scope for now, just to get through the basics of this. But Fannie Mae and Freddie Mac are heavily involved in the secondary market of real estate loans. It gives stability and liquidity to banks and stability to the overall real estate market. So banks will fund loans that meet Fannie Mae and Freddie Mac's guidelines, conventional guidelines. The government gets paid by either accepting mortgage insurance premiums, or they will buy bundles of loans usually in 1,000. They'll buy 1,000 loans that have been bundled. 2008 happened because all of those loans were bundled and horrific. They were just really bad bundled loans. Banks were giving awful, awful, awful loans. Fannie Mae and Freddie Mac didn't have really any guidelines they were requiring. So banks were giving just horrible, horrible loans, bundling them in the thousands, and then selling them to the Fannie Mae and Freddie Mac. And when people say that they're too big to fail, unfortunately, they were wrong. Let's talk about pros and cons of conventional and FHA. So pro for conventional, 3% minimum versus FHA's 3.5%. A lot of times what we will be doing with first time buyers is weighing these two products. 3.5 for conventional, a little bit higher interest rate, typically a little bit lower mortgage insurance. FHA, a little bit higher down payment, 3.5%, better interest rate, a little bit higher mortgage insurance. Typically, the payment is a few bucks cheaper. I mean, they even out pretty good. But FHA, typically it's a little bit cheaper. The problem with FHA, one con of FHA is that the mortgage insurance is on that loan for the life of the loan. If you keep it for 30 years, you're paying insurance for 30 years, $200 to $300 on top of that loan for the life of the loan until you refinance it or into. Whereas conventional, it drops off. We can remove the mortgage insurance once the bank has deemed that you have 80% loan to value. So there's some benefits and cons, pros and cons there. With conventional, FHA. The main reason people go with FHA, keeping those two things in mind, is the debt to income is considerably higher. That banks will go up to 54, 55% sometimes, not always, depending on everything, but into the 50s for sure. Whereas that just doesn't happen in conventional. They're really trying to keep those into prefer low 40s, 41, 42. So we can get it up. We can get it up past that. We can get exceptions. Banks will make exceptions for that. Let's see. I have it pulled up. I don't want to guess. Conforming loan limit for right here. Conforming loan limits for conventional right now 726,200. And FHA is 685,400. These are the biggest jumps in history. These are just massive jumps in loan limits. That can come into play a lot of times. A lot of times, you might think we might do the numbers and say, hey, absolutely, FHA is the way to go on this one. But then they get into a home price where it doesn't match up anymore, or conventional is the way to go, but it's putting them into a jumbo conventional loan, whereas they would still be under the FHA loan limit. So even though, conventional might have been the best way to go under this circumstance, now we jump them over to FHA. So there's a lot of times we're bouncing back and forth until things kind of come together in the loan process. So a lot of times we don't know up front what type of loan they're going to do until you figure out the house. We really lock down numbers and all the different things there, but I did want to kind of throw that out there. And I need to figure out how to get back. So the difference between conforming and jumbo, or conventional and jumbo, conforming and jumbo loans. Jumbo typically will have a slightly higher interest rate. They could also require reserves. Yeah, we're going to lend you a lot more money. The risk is higher. We want to see 6 months of reserve payments in your account, even though for us to give you the loan. You don't have to put the money down, but we want to see it in your account as a reserves. So there's some, front end and back end ratios. I see that there's a note there. So front end is your debt to income ratio only considering the mortgage itself. I'm going to use easy numbers. You make $10,000 a month. The mortgage comes out to $4,000 a month. You have 40% front end debt to income ratio. If you have an additional $2,000 of liabilities monthly, you now have a 40% front end and a 60% back end. When we're looking at debt to income ratios, we're considering both, but the final is really determined by your back end debt to income ratio, which is why we're also looking at credit card and car payments and all these other things. And so a lot of times we say, hey, is there any way you could refinance this car? Or let's say you co-signed on your sister's car. Hey, it's been a couple of years. Do you think your sister can refinance and take your name off of that car? There are weird different things we can do, but to get around that also. But I would say I'm going to try not to get super nuanced and go down rabbit holes here. But there's lots of things we can do to try to get people's debt to income ratios moved around and give them alternatives. Alternative solutions. And maybe it's an instant thing. Maybe it requires 3 months. Maybe we need them to move some debt around and do some consolidation. Maybe we have them pay off. Maybe they're going to put a bunch of money into the house. Maybe we have them pay off some of these debts. You know, we've like, you know, an easy one is somebody selling a house. I want to put all the equity into the next house. Well, you've taken on some debt while you bought that house. How about we take a small percentage of the equity coming from one house. We pay off these cars that you have financed on 3 or 4 or 5 years. We use the same money. We leverage that money and we finance it into the house. It's the same amount of money going into debt, but the interest rate on the home is a little less, and it's amortized over 30 years instead of 5 years. So it lowers your overall, the payments are lower. So it lowers your overall debt to income ratio.
Tristan,
Yes.
is there ever a time
voice.
that the solar whatever on a home is factored into that?
Always. If there is a solar lease in place, we have to see. There's another. Thank you for asking that question. There's another good example of why TBD has some risks. So always consider that if you're a listing agent and they have a TBD pre-approval, it's not. I mean, it's not bulletproof. I hesitate to even say that. I wish I could take that back. But the truth is, at TBD, I would not say that just because somebody is TBD underwritten does not mean that they can. I see people use that to leverage their deals to try to get an offer accepted, which helps. I mean, I get it, but it doesn't mean they're fully underwritten and you're going to be closing and funding in 5 days. Adding the property really does finish the underwriting process. So for example, if they are pre-approved for a certain amount and they asked us to max that out, and then they have to now buy this house that has $30,000 of leased or financed solar, they have to qualify for that as well. So we have to run another calculation, or it has to be paid off in escrow. I mean, it absolutely adds to the requirements. I mean, that because they're taking on additional debt, they're taking on additional liabilities, just like a car payment would be. They're now taking on 2 loans. They're taking on the liability of the mortgage, and they're taking on the liability of anything that's leased. Sometimes we'll see HVACs, you know, hot water heater. Well, hopefully not that. That's $1,000, but you know, there are these government lease programs and loan programs where you can finance a bunch of things additional onto your house. More times than not, they get cleared. But sometimes when it's a leasing type scenario, or solar is financed or leased, all the additional stuff has to be factored in or paid off in escrow. It's a good question. Did I answer your question, or did I use it?
You answered it. It doesn't seem fair with the lease though, because you know it's going to be offset partially by the PG&E. You know, the utility bill is going to be
discount.
offset.
Yeah, the discount in the bills.
Gosh,
but
wow,
it is a monthly bill that is
Yeah.
now on. They use their credit. I mean, if they have crappy credit and the solar company isn't willing to lend to them, I mean, they still have to. It still has to be financed or leased, and they still have to meet that. But yeah, I totally understand. It makes perfect sense that yeah, you are financing it, but it is offsetting cost. But you are still financing an asset.
Thank you.
Yeah, absolutely. Thanks for asking questions. Questions are awesome. They make this way easier. Because and I think it makes it a lot more understandable and graspable. Is that even a word?
I don't think
Anybody?
so.
Graspable?
I don't think
Graspable?
so.
I don't think it is. I get back into current slide. All right, we actually touched on a lot of this, but name changes, we can deal with that kind of stuff. Honestly, write the contract any way that you can. We will have to figure out legal names and make sure that we are proving their legal name. And a lot of times, we have to do an amendment in escrow, and we can change names to be added to title. The screens are covering up some of this stuff. So FICOs, we've talked about that. 580 minimum, not really the minimum for most things. Every bank will make a determination on what they're willing to lend on. Credit scores are not the end all be all though, because if you have a 800 credit score, but you have other risk factors, the bank's going to combine those and make a determination on total risks. Divorces, if you are going through a divorce, I hesitate to, if you're going through a divorce, okay, so let's just do it straight up here. If you are going through a divorce, we cannot give you a loan if you've disclosed to us that you're going through divorce, unless the party, your spouse, is aware that you are getting a loan and is willing to sign a quitclaim deed. If they are willing to do that, we still would need a divorce decree, which states any potential monthly liabilities that could come of it. I mean, we need to see, is there alimony? Is there child support? What we have to see that. If not, we have to wait until it is finalized. I get this happens a lot sometimes, and it is the most complicated part. The reason that VA does not fit into that as well as FHA and conventional does. Let's talk about a scenario. Rihanna, you might be familiar with the scenario quite like this. Let's talk about a scenario where a member of the military is getting divorced. Their soon-to-be ex-spouse is willing to participate and sign a quitclaim. They're on reasonable terms. And the let's call it the wife in this scenario. The wife is buying a house. The soon-to-be ex-husband is willing to sign the quitclaim deed. The wife has good credit and wants us to. So we start to do that loan process. The holdup is, does anybody remember what we talked about with the VA? One of the nuances to VA loans.
You got to use the debt of the.
We have to run both spouses' credits. So even though this spouse is not going to be on the loan, they're about to be divorced, they're willing to sign a quitclaim deed, we still have to run their credit, and this spouse is still responsible for the debts from the soon-to-be previous spouse. And if their credit score isn't very good, it could either throw the deal or lower or hurt their interest rate, because we have to use the lowest middle score. Let's see. Any other questions about that? Oh, medical. Medical is a good one we get a lot. If you have issues with medical, like medical and collections and things like that, we can take that off. We actually can get rid of those unpaid medical bills, and we don't calculate that into the debt to income ratio, but we cannot, but it still has more than likely it's affected your credit score. So we're still at the mercy of the credit score, but we can take medical off those debts. So just because somebody is behind in medical bill payments doesn't mean we can't finance them, or that they're not going to meet the income requirements. Something to keep in mind when you're having conversations.
And what's the golden rule? Don't make any purchases 6 months prior to you wanting to purchase a home.
Yeah, and yeah, that's great advice. That's perfect advice. I would love that. Thank you. Tell everybody that. That doesn't always happen though. And really what goes south a lot of times is somebody will be buying a house their offer doesn't get accepted or something goes sideways and we have to tell them, this didn't go well, but for this or this, can you fix it? They get upset. They couldn't buy a house, so they go out and finance a car. Then another house comes on the market that they really like. Even though they were heartbroken about missing this previous house, they come back. I love this house. We have to have this house. We love it. More than the first one. Oh, okay, great. You're ready to rock and roll. Oh crap, did you just finance a car? That happens more times than not. But yeah, absolutely. If you can not add new debts 6 months prior so that your credit is fairly stable, it hasn't taken that initial hit that takes to come back up. That's ideal, obviously. There are scenarios, a lot of scenarios, I mean, a heavy percentage of applications we get in. We ask a lot of probing questions. What's going on? This and this and this. We usually ask questions about one of the first conversations I ever have with a new borrower is credit card debts. Hey, do you use your credit cards regularly? Yeah. I use them every month and I pay them off. Well, and I make myself an example. Well, I can tell you that my credit score swings 80 to 125 points every single month, depending on when my credit cards are reported. Because I use thousands and thousands of dollars on my credit cards every single month, and then I pay them off every single month. But if those balances were still on those cards before they were reported, your credit utilization shows up incredibly, very high. And if it's over 30%, you take a massive hit to your credit. If it's over 10%, you take a hit. But if it's over 30%, you take a really heavy hit. So we always ask, well, where are you in your credit card cycle? Before we run your credit, maybe can you pay those off? And then maybe we should wait a couple weeks. Or are you moving around? Are you paying things off or moving? I mean, so we try to figure those things out. We can do a rapid rescore. Of course, then we have to submit it to the bank again and all this other stuff. And then it costs money to do a rapid rescore cost. They have to pay for that, which is not ideal. But credit card, unfortunately, I'm not the biggest fan of our credit reporting agencies and the way the government looks at credit. But it is what it is. And so we have to manipulate it the best that we can. That was good. Thanks for that, Anastasia.
No
Anything
problem.
else? Story time? Any good questions? You got a lot of great realtors here. A lot of experience. Anybody jump in, please, anytime, to answer some of this stuff. That's a weird slide to have on here, but okay. Appraisal issues. What could be some appraisal issues on FHA? What's somebody seen recently? There's one that comes up a lot. We see. It's like the only really issue that we see sort of with FHAs most of the time.
Comparables.
Comps is an issue, is a weird one right now. We are fortunately, it seems like the appraisers are understanding of what's happening, and they're not, gosh, I mean, honestly, appraisal should be really easy right now, because with a traditional appraisal, you go back 6 months in that neighborhood. And so we should not have any appraisal issues. Appraisal issues are a bigger issue on the way up. When home prices are increasing rapidly, you go back 6 months and that same whole house would have sold for 30,000 less. So right now we're not having as many appraisal issues, very few actually. Appraisers, unless there's not a name for these types of appraisals that can be used in polite society, but appraisers that start calling things that inspections didn't call and holding up loans, man, there's a special place for those people. But we do. So what is required for the appraiser is double strapped water heater, oven, a running toilet. Some of these things are for FHA. They don't want chipping paint. Like, there are just certain things that we run into some little things like that the VA, or excuse me, that the appraisers, different types of loans consider livable condition. A home has to be considered in livable condition to meet certain requirements. And if they don't, we have to either address those issues or switch to a loan type that does not have those requirements. One issue with VA and FHA is that appraisals stick to the address, the file number. And so if you have a bad appraisal, and then you go back to market because it blows a deal. Unfortunately, you're not going to be able to accept that an offer from the same loan type for 90 days. Any good appraisal stories? Educational appraisal stories?
I have a
Uh,
horror story for appraisal.
Hit us with a horror story. And then
So,
hopefully somebody has a positive story.
so
sandwich it.
the house that I was selling was, the buyer was coming in, he was VA.
Okay.
So the appraiser that I got was hung up on the solar. Solar's paid for. There's no outstanding on the solar. UCC showed there's no lien, nothing. She was hell-bent on paperwork. Well, they had purchased the solar through Peterson Dean. Peterson Dean is now bankrupt.
Right.
So we couldn't track down any paperwork. It was paid off, so he got rid of the paperwork.
And
And
it didn't show up on the prelim or anything as previously, and yeah, that sucks. Okay.
so she came in and she did the home inspection, still hung up on that solar. And I'm like, there's,
Yeah,
so
it's
we gave
weird
her
that the
comps.
appraiser cared about solar,
So
or
we
the
gave
financing
her,
portion of it.
we gave her the comps for the area.
Ah, that's why.
She came in 20 grand under.
Thinking that, estimating that you owed 20,000 on the solar.
So, and they even had the 9.2 megahertz on the solar. So they even add the upgraded solar.
Hmm.
And there was no way to challenge it or contest it because we were already,
Yeah, I'll say you didn't have time to appeal.
nope. My sellers were already gone. They were already in another state.
Hmm. So they
So
asked
they
for a
had to-
reduction in price, or was there a
They,
negotiation?
they
Or?
sure did. They said, if you want us to buy this house, we want it for this amount now. And if you don't, then we're walking. Yeah, that was my nightmare.
Yeah.
So we're glad. So somebody give me a positive to show me that it's not, that I
Yeah.
just didn't have the world's most horrible appraiser in the whole wide world.
No, it sounds like you did. It sounds like you had one of the terrible ones. Any great appraisal surprises in the positive? I'll give you one. Back when I was in brokerage, we had a custom 2-bedroom house that was selling considerably higher than any 2-bedroom home had sold within miles, because it was on Buck. It was right, actually it was on Main Street. It wasn't even on Buck. It was right here. And we couldn't get an appraiser to touch it. Finally had an appraiser accept it, showed up, bagels and coffee and kind words, and the guy, and had many conversations with the guy before. Thought this deal was going to blow. It's a very, very old historic home in Vacaville, and we just couldn't anybody to take consideration of that. And this guy bent and everything he could, came up with, and this was a long escrow because we were having such a hard issue with the appraisal. We had this guy who's a really, really nice guy. He went back as far 18 months to the previous historic home. He made an exception to that. And then he also went out of area to like projects in other areas, other cities, to show, and was able to write an appraisal, had to come back and report a few things to the bank. But that guy went way out of his way And I've had probably 10 different experiences like that, especially in commercial, but I've had quite a few experiences like that where if we were able to explain the circumstances to an appraiser and they went out of their way to make sure that we made value. So there's been some
Tristan,
good ones.
does that cost more than the regular appraisal? I'm
It's a bidding process, to be honest. So, I mean, in that case, I don't think so. I'm trying. Sorry, I don't remember what that appraisal cost. With, but there is a bidding process to appraisals, and especially within commercial or non-conforming residential loans. You put the project out there. The bank puts the project out there, and appraisers bid on it, and you say, okay, I'll go with that one. A lot of times you take the cheapest one, but you know, you're not technically allowed to know who is bidding on, like, who the appraiser is. You're not allowed to pick the appraiser that you know, but it's not difficult if you know good appraisers and say, hey, I'm putting this project out. You know, I'd like, you know, we've had great appraisals with each other in the past. Now, this doesn't really happen in residential because it's too big and there's too many in the process, but with commercial and some investment type loans, you know, there's ways around it where, you know, they may bid some weird, awkward, random number with decimals or something, and you know, you know who bid that. So there's some ways around appraisals and stuff.
So
But that
let's
is
say,
rabbit
let's
hole.
say I get this nightmare appraiser again. Can I reject her? Is there a way to do that, to reject an appraiser if we had a bad experience with them?
Or multiple. Interesting question. Yes, yeah. You could more than likely have that. You can't do that on a regular basis. Lenders, we can't, because I mean, you wouldn't be doing it. I would be doing it, or lenders would be doing it. In some circumstances, you could get that done. You could claim conflict or of interest, or that you could claim something and make that happen. You probably couldn't do it on a like often. But yeah, under an extenuating circumstances, I think that there's probably something you could do. You would then be delaying your, you know, a lot of this comes down to, like you mentioned before, time restraints. But if
Okay.
you know, I can tell you I've never done that. I mean, I've contested many appraisals, but I have never declined. I have never fought to not have an appraiser, even though I had bad experiences with them prior.
Well,
If
I'm
I had
sure
time,
if we didn't have the situation that we had, I'm sure we would have. But
Mhm.
unfortunately, our hands were tied, so we had
Yeah.
to, you know, accept what she gave us and went and had to go with it.
Right. Yeah. Oh, loan estimates. Okay, so it's a little vague. So loan estimates are something that we lenders will give out up front. You know, it can be a proprietary document. It can be very casual. It can be any way you want to break it down. It is just a estimate of, if it's a good one, all the costs broken down into prepaids, which would be like prepaid taxes and insurance, loan costs, which could be an underwriting fee or a processing fee if there's a third-party processor, and then also escrow and title costs. So your breakdowns. So you've got, that's a loan estimate includes those. Like, we assume with these things that you will get that your costs will equal this up front. We are also assuming that if you borrow this much money at this interest rate, your principal and interest payment will be this, your taxes will be this, your insurance will be this. So these are all your upfronts and these are all your monthlies. That's a very casual thing. You can type it up as formal as you like, but it's just something that we give out when we're pre-approving. So then there's a loan disclosure. Once a lender receives, and this gets violated sometimes, but once a lender receives an application and we receive certain key pieces of information, a certain number of, we have no choice but to send out a loan disclosure. And we are now disclosing all the same information, but in a much more formal document. And there is a formal loan disclosure that needs to be sent out. And it has all of that stuff broken down. So they're very, very similar. One requires information. One, we are voluntarily giving information because we want them to understand, what they could be getting into. Because a lot of times, especially say Zillow leads, a lot of times we get leads and they're like, yeah, we really want to buy this house. It's $475,000 or $500,000. Oh, okay, great. Let me get you some numbers together and actually this way. Whoa, 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 whoa. Why is it that much? Well, okay, let's break this down for you. Like, let me go through it with you. And they're like, oh, well, we can't afford that. And sometimes this happens before we actually run the credit and do a full profile and pre-approve them. Sometimes it happens afterwards. They technically can afford it based on banking guidelines, but maybe in their life or they're not willing to sacrifice quality of life to make that payment. So, oh, okay, well, you don't. So what is the max payment you are comfortable making? Oh, okay, well, then let's adjust because your pre-approval, you're actually, if you're only willing to make that payment, your pre-approval is this. Oh, you only have so much down payment. Okay, well, that limits what you can purchase, but I can afford a lot more. Well, unfortunately, you are restricted based on your down payment limitations. Can you get a gift from family? Other things. Can you borrow? Can we refinance a previous property and pull some cash out or do a HELOC or something? Can you get access to funds another way? Let's get creative. You have any assets you're willing to sell? I mean, how many people have either seen or sold their favorite car or their motorcycle when they're having a baby, their first, and have to buy a house or something like that? I mean, we see that kind of stuff all the time.
Trystan, why is there such, so I had some Zillow clients, they pre-qualified for like a townhouse condo, 550. And then they were like, oh, well, let's check out mobile homes. And I said, well, mobile homes is a different lender. You have to go through a different process.
Yeah.
That one came back 250.
Yeah, it's awful.
Why?
So we do mobile homes.
Why is it such a difference?
Yeah, so we just added mobile homes and we're all having to spin up and it's a mess. It's an absolute, excuse me, I almost dropped. Yeah, it is a way different calculation. These are now private lenders. So a mobile home is not considered real property. It is it's personal property. It's chattel. If you just took the real estate exam, most mobile homes are registered with the DRE, and so there's not an APN number. They have to qualify for all the park fees, kind of similar to a condo. You have to qualify for the HOA. You have to qualify for all the park fees, which are significantly higher. A traditional HOA in this area is between $350 and $425. All of the park fees in this area seem to be like $829, eight in the 800s. So there is a direct number there, but also lenders aren't willing to go up as high on the debt to income ratios because they consider mobile homes a depreciating asset where a home is considered an appreciating asset. So it's like financing a car, more or less, because it's registered with the DMV. When you finance a $40,000 car, the bank is assuming by the time this note is paid off, that car is not going to be worth 40 grand. It's probably going to be worth 15 or 10 or 20, whereas, so their collateral is becoming less valuable through the life of the loan, which is a risk. And the risk of them walking away from that note is considerably higher. Whereas the traditional real estate statistics and knowledge tells us that over time, home values increase, land increases. So the bank assumes that their collateral is going to only become more valuable and less risky during the life of the loan. Without going into a bunch of weird details that I barely understand at this point, I just know that's the best answer that I can give you on the difference between mobile homes.
And I appreciate it. Thank you.
Yeah, it is. Mobile homes it's a challenge. It's we've had a couple that we thought, oh yeah, this is easy. This is gonna be a shoe in, and the requirements were just weird, and the numbers didn't make sense, and it was like, oh okay, they declined it, so now we pushed them back over to condo. Okay, we're buying a condo. Significant. Sorry, you didn't qualify for the $100,000 mobile home, but we can get you into a $300,000 condo.
Right? I'm just like, why would you do that when you can have this?
Right.
So, and their big thing was they wanted a garage because
yeah.
he's got a really nice car. And I'm like, mobile homes don't have garages. So
yeah, a lot of times though they'll have like a storage shed or some outdoor land with an overhang. And a lot of condos, you don't get that overhang.
Yeah, the ones that we've looked at, we're fortunate enough to have garages, the condos and the townhouses, but yeah, so hopefully I can steer them back to the condos.
Yeah, we run into that. People that are mobile home people are just mobile home people. And I mean, yeah, kind of okay. I see it there, and they spit pros at me all the time. I'm throwing cons their way. They're hitting me with the pros. They know what they want, and then they're happy with it, and I think it's great. Prepayment penalties. Okay, so that is not something that happens with your traditional loans. FHA, VA, conventional. There are not traditionally any prepayment penalties. That is not the case with commercial loans, private loans, non-QM loans, bank statement loans, DSCR, debt servicing loans. Those are traditionally private investors that have agreed to put their money up in exchange for a return on their investment, and they're going to be quite upset if you pay them off early because they were looking forward to more than likely it's 5-year prepay penalties. We have private loans. When I say we, I mean in most brokers, we have private loans that are 1-year prepay, 3-year prepay, and they build that in. They build the interest rates into knowing that, hey, you may refi this in 1 to 3 years. A lot of private investment and commercial loans are amortized on 25 years with a prepayment of 5-year prepay. And that's what you'll see in almost 90 to 95% of those loans have a 5-year prepay, and they ladder. It is, if you pay it off in the first year, there's a 5% penalty. If you pay it off in the second year, there's a 4% penalty. If you pay it on the third year, it's a 3% penalty, and it goes down. And if you pay it off, the last year, within 6 months, you can usually get a waiver for it. But if you pay it off a year before you're supposed to, you're going to pay a 1% penalty in the amount of the loan. That is unless you are refinancing with that same bank and they've made an exception, or you're purchasing forward, selling to purchase with that same bank, and they are willing to give you an exception or waive the prepay on the one loan because they're getting a new loan from you. Any questions about any of these things? Interest rates, monthly payments, closing costs, prepayment penalties. I can't read the top one. It says provide by of loan. Anybody want to read that to me? Okay, thanks guys.
Provided by lender within 3 days of loan application.
Perfect. Yeah, we went over that one. Closing disclosure. So a closing disclosure is somebody read this to me. I don't want to go in a different direction if I'm not touching with it. What it says, what is a close provided by lender? Trinity.
3 business days prior to closing.
Okay, so the closing disclosure is the same thing as the loan disclosure, but our upfront disclosures or our initial loan disclosures are estimates. These and we get closer as you know, our closing costs narrow in and we figure out exact fees. The taxes get all settled and figured out. During escrow, you've locked in an insurance policy for the home during this process. And by the time we've gotten till the end, you get your final closing disclosure, your closing disclosure. Like those numbers should be tight. They should be pretty like exact-ish. I'm gonna say exact-ish because there are exceptions to that. So we send the CD out 3 days prior, get signatures on it. We can make small modifications of it can't affect loan amounts and stuff, but we can make small movements on the estimated seller closing statements and make some small movements. But this last closing disclosure needs to be pretty tight. And it's all the same information that's provided up front, closing costs, out of pocket. At that point, honestly, seller credits have been included because maybe there was some seller credits negotiated into the as part of your negotiations through the inspections. I mean, a lot of different things kind of change, but yeah, basically the same information as the first one. What are your closing costs? How do the closing costs break down, the 3 types, and then any other costs and credits of the loan, and then what your monthly payments are going to look like, and how do those monthly payments break down. Ooh, hey Trini, will you read these to me?
Estimated costs and payments.
And
Mortgage lender / loan officer, lock in interest rate, calculate closing costs, and monthly mortgage payment.
So the interest rates, so it's different because we're brokers. But so traditionally, as you know, interest rates are moving. They're based on mortgage-backed securities in the bond market, and they are moving constantly. I mean, they're ticking up, maybe hourly, maybe every 2 to 3 hours. They're going up and down all day long, and they do that until we lock an interest rate. So we have to get an application. We have to be into contract, typically, or get into contract, submit the file to a bank, the bank that we intend to use, and in a broker's case, the bank that we intend to use. In retail, obviously, they just receive the file, log it. And then we have conversations with the borrowers. And, you know, in a lot of our conversations, I have to break the ice by, you know, making a joke. Hey, you know, are you gambling? Because, hey, we've had a good day in interest rates. We had a good day yesterday. We had a good day today. You know, here is what the data is kind of saying. It could go this way or the other day. You know, there's some announcements being made tomorrow. You know, there's a lot of, you know, would you like to lock in this interest rate? Are you comfortable with this interest rate and what the payment's going to look like? Or would you like to float this and wait another couple of days and see if it gets better? It's totally up to you. What do you want to do? Once we've locked that interest rate, we have to lock it in at, say, 30 days or 40, 45 days. If we lock it in, there's really no benefit to locking it in 14 or 20 or 18 days, but we can do it. We don't do that, though, because there's just no benefit. It only adds risk. And so, but if, let's say, you want a 90 or 120 day or a 180 day lock because you have a long escrow, you're building a house or something like that, we can do it. But the bank is going to charge you for that insurance policy that you've now set for yourself. So you're either going to pay, a premium on that rate. So whatever the interest rate is for that day, you're going to pay a larger premium, the farther out you'd like to lock that rate. I already broke down how we calculate closing costs. It is a prepay, which we call prepaids, are pre-funding, or the money that you would need to upfront to fund your impound accounts, which the bank will then hold for you in most cases, and pay your property taxes and insurance throughout the year for you. all the closing costs that are lender closing costs. There are title and escrow closing costs, prepaid closing costs. And then there can be some other little, the county charges a recording fee. I mean, there's some little things like that. All of those get put into calculating your closing costs. And then there is your down payment, not to be confused with closing costs, which does happen quite often. Monthly mortgage payment, principal, interest, taxes, insurance, or interest, taxes, and insurance if it's an interest-only loan, or in some cases, a lot, 20% of times, your mortgage payment that we calculate for you is just principal and interest or interest only because you've chosen not to impound funds and pay your property tax and insurance on your own. Yeah, sorry. You guys still hanging in there? Is there any like specific questions you want to go over? Anything quick? I know this is kind of dragged on. Trinity, my lovely assistant, thank you for making a very long, very thorough PowerPoint for us. Mortgage calculators. So there are tons of mortgage calculators. I mean, we have one. It looks like Realty One Group has one. All the title companies have one. There's a bunch of private ones. It's basically just you input, estimate your taxes and insurance and the home value and what the interest rate is, and it'll calculate that for you on your phone. So that's an easy one. Hold on, I'm gonna move this screen. Click on drop down menu in your app to share it with your buyers. There you go. So Realty One has a great one. It looks like they provide. We also have one. Hey Ed, are you there still?
This is just something that Amy goes over with us to do 3 calls, do 3 ads, and make notes.
Hey guys, do what she just said. Make 3 calls, do 3 ads. What's an ad? Like a Facebook ad or an Instagram ad or?
Adding 3 people to your database.
Oh, nice. Cool. And then 6 notes. What is the notes? Okay.
Oh, sorry. I thought it was.
Yeah, no, it's all good. Hey, and that's
Um,
us. What do you know? Good job, Trinity. She did this last minute this morning, so we are missing our processor and our processing assistant, but I don't know where you to squeeze those in anyway. Maybe up in the corner or whatever. Everybody take a vote. Who votes that Brett should have to take another picture where he's not so close to the camera?
Don't pick on.
Also has a full beard right now.
Yeah, I know, with a full beard. Brett, are you here? I still don't know who all the participants are. No?
He just had to
Okay.
step out.
Oh, okay. Awesome. Well, now I'm making fun of him and it's rude. Crap. Great. Awesome. Hey, any other questions? This was a lot of fun. Thanks for sticking with us. And like I said, this was my first time teaching a Rev Up class, and it was actually my first time using the Zoom to teach a class. So I typically prefer being in person. I can see everybody and we can have conversations and stuff, but it was fairly close to an open conversation. Does anybody else have stories or questions about anything before we go? Okay. All right. Well, everybody have a great day.
Make sure you guys
Save-
log your attendance. The link is in the chat.
Awesome. And then, yeah, so like I said, this is our team. We're the new in-house lender. We're really happy to be here. And we hope that you guys will reach out and contact us or come by the office anytime. We're happy to have a chat.